Eyes on the board, squad. 6 minutes. That's what it takes. By the end of this dispatch, you'll know what a perp actually is, why max leverage is a countdown, and the one rule that keeps your account alive. Most traders learn this by donating their account to the market. You're getting it for free. So, what the hell is a perp? 2 ways to bet a coin goes up. The first you already know, spot. You buy the actual coin, you own it. Bitcoin runs 80,000 to 100, you made 20 grand of real BTC. It craters to 40, you're holding 40 grand and waiting. The position never expires, you can sit on it forever. The second is a perpetual, a perp. You don't buy the coin. You open a contract that says, I'm betting it goes up. If it does, the contract pays you. If it doesn't, it eats your collateral. You never hold the coin, you never deliver it. And it never expires, that's why they call it perpetual. It settles in stablecoin USDT on Aster. Long profits when price climbs, short profits when it falls. So yes, you can bet against a coin you don't even own. That's the whole point. That's the door everything else walks through. Now the part that gets people wrecked. Leverage. A perp lets you put up less money than the position is worth. Put up $100 at 5x, you control 500. Bitcoin ticks up 1%, you make 5% on your 100. Leverage multiplies your wins, and it multiplies your losses exactly the same. Bitcoin drops 20% at 5x and your whole 100 is gone. Position closed, money taken. That's liquidation, and the math is brutal and symmetric. It does not care which way you hoped. Aster will let you crank it to 1,000 to 1. And even Aster tells you don't. 1001x, that's not bravery, that's a countdown to getting wrecked. You're not a gambler. The Forge was never built to crank leverage, it was built to win on high probability, delta neutral, maximum yield, minimum risk. Survive first, print second. 2 words locked in. Liquidation. Your losses chew through your margin and the exchange force closes you before you go negative. Your collateral gone. Margin. The money you put up. The buffer between you and getting wrecked. A perp's price wants to drift off the real coin, nothing physically chains them together. So the exchanges invented funding payments to do it, a small fee paid between the two sides every interval, dragging the perp back to spot. On Aster, paid every hour. Perp trading above spot. The longs are too greedy, longs pay shorts. Below spot, shorts pay longs. Small in the moment, hundredths of a percent, but collected every hour for a year. A 0.05% hourly rate annualizes to roughly 438%. That is why the Forge exists, to hunt the markets where one side is paying a heavy tax just to hold the trade, so it's not you paying it. Here's a live one on Aster, 0.25% funding, 45 minutes on the clock. If you're long when that timer hits 0, a chunk of your collateral becomes somebody else's. Every screen shows 3 prices, and mixing them up is how beginners get wrecked. Index price, the average of spot across the big exchanges, the closest thing to the truth. Mark price, the index blended with funding. This is the number that triggers your liquidation, not the chart. Last price, the most recent trade on Aster itself. The prettiest and the most useless for survival. It wicks and lies when liquidity's thin. A wick on the last price can stab past your liquidation level for a heartbeat, and if the mark price didn't move, you live. But let the mark price quietly drift past your line and you're done, even if the chart never visibly touched it. So watch the mark. Set your stops against the mark. The chart can lie. The mark doesn't. And if you're a lone wastelander navigating this wasteland solo, don't. Hit subscribe and join the DeFi Warlords in the Telegram. Links below. Back to the board. When you open a position, your collateral runs one of 2 ways. Isolated, only the margin you set is on the line. It gets liquidated, the rest of your account is untouchable. Cross, your whole balance backs that position. It'll pull from your other money to keep the trade alive, right up until it can't, and then everything goes down with it. Cross gives you flexibility, hedging, offsetting positions. But in untrained hands, it's a foot gun that wrecks your whole account at once. So the rule, until you know exactly why you'd break it, first trades always isolated. Wall off the blast radius. The order book is every buy and sell order waiting to fill bids below the price asks above. When you trade, you're one of two things. A taker hits an order already sitting there, fills instantly, pays the higher fee. A maker posts an order that waits in the book, might never fill but pays a lower fee, sometimes earns a rebate. Beginners default to market orders, taker fills. Fine when you're small, but as your size grows, makers save you real money. Fees are a tax you can choose to lower. One last term because this one saves accounts. Reduce only. It's a checkbox on every order, and when it's on, that order can only shrink a position. Never grow one. You go to close your long, your hand slips, you hit buy instead of sell. Reduce only refuses. It will not add to the position. It just declines. This is how I close reduce only, scaling out a piece at a time. Use it on every exit until it's muscle memory. It costs you nothing. And one day it's the difference between booking the trade and wrecking your own position on a fat finger. Now you speak the language, spot and perp, leverage and liquidation, funding the three prices, your margin mode, the book, and the shield. That's the foundation, and most people sprint right past it, straight into getting wrecked. One rule before you move out: the leverage that makes the gain makes the grave. Survive first or get wrecked. Next briefing, we walk onto the trading screen and open a position. That's part 2. The full intel and the next 2 parts live on the DeFi Warlord Forge. That's the briefing, squad. Stay sharp out there. Subscribe, turn bell notifications on, join our DeFi Warlords home base, link in the description, and salute to the squad.